Let's continue with the lean accounting practices. Let's continue with value stream reporting. Costs are collected and reported by value stream. Consider a plant of the auto parts manufacturing company that produces only 4 products. Within this plant are 2 value streams. First, aluminum wheels, models A and B, and the second, steel wheels, models C and D. The figure shows a profit and loss statement for the plant for the week ending April 14th. The plant had significantly increased its sales of steel wheels to auto manufacturers that were replacing low-end aluminum wheels with steel units on new models. Costs outside the value stream, sustaining costs, are reported in a separate column. The revenues and costs reported are the actual revenues and costs for the week. To avoid distorting the current week's performance, inventory reductions are reported separately from the value stream contributions. Adding the inventory changes also allows the income to be stated correctly for external reporting. Using the average product cost for a value stream means that the individual product costs are known. In reality, a fully specified and accurate product cost is not needed for many decisions. Waste can be eliminated at the activity and process levels without knowing product costs. We do not need detailed variances by product to signal sources of waste and potential for improvement. In fact, as already noted, standard costing variances may actually impede improvement decisions. For other decisions, the effect on the decision on the profitability of value stream may be the only information needed for certain decisions. For example, special order and make or buy decisions can be made at the value stream level. Consider a make or buy decision. Suppose that the auto parts company is currently purchasing a component used in making its wheel products and is considering making the component. The decision can be made by comparing profitability of the value stream under the buy scenario with the profitability under the make scenario. A typical analysis would look like as follows. The profitability of the value stream increases under the make alternative, and so the decision would be to make the component rather than to buy it. While analysis on the effect on value stream profitability has its merits, it also has its perils. Many of the decisions are short-term in nature and do not reflect the long-term consequences. For example, acceptance of a special order below the full cost of a product may increase value stream profitability because of existing unused value stream capacity. But continued acceptance of such orders may not earn the return necessary to replace capacity that is eventually exhausted through use. Thus, other very important decisions may need individual product cost information, and a lean accounting system must provide this information. Performance measurement. Abandoning a standard costing system also removes a major operational control system, and it must be replaced. The lean control system uses a box scorecard that compares operational, capacity, and financial metrics with prior week performances and with a future desired state. Trends over time and the expectation of achieving some desired state in the near future are the means used to motivate constant performance improvement. Thus, the lean control approach uses a mixture of financial and non-financial measures for the value stream. The future desired state reflects targets to the various measures. Operational, non-financial measures are also used at the cell level. A typical value stream box scorecard is shown on this figure. For the operational measures, units sold per person is a partial labor productivity measure and is therefore a measure of labor efficiency. Productivity measures are discussed more completely later in the course. Dock-to-dock is a cycle time measure and is the time it takes for a product to be manufactured from the moment materials arrive at the receiving dock until the finished product is shipped from the shipping dock. First time through is a measure of quality and is simply the percentage of product that made it through production without being defective and thus needing to be rejected or reworked. Capacity is labeled as productive, value-added, non-productive, non-value-added, and available, unused capacity. The scorecard measures are expected to improve over time and to be helpful in managing and bringing about improvements. For example, from this box scorecard, we see that the non-productive capacity is targeted to go from 46% current state to 30% future state, with productive capacity increasing from 20% to 25% and available capacity increasing from 34% to 45%. As waste is eliminated, the non-productive capacity converts into available capacity. The machines, people, and other resources used for wasteful activities are now available for more productive work. For financial performance to improve, some decisions must be made with respect to the increase in available capacity. The most sensible and practical approach is to commit to use the freed up resources to expand the business. One possibility is to add new product line. Another possibility is to transfer the resources to other value streams that are in a high growth state with increasing resource demands. Another is to realize cost reductions by reducing headcount and eliminating resources. This latter approach is the least desirable. It makes it hard to gain the cooperation and involvement of employees with the transformation into a lean workforce if their suggestions and actions are going to lead to the loss of their jobs or the jobs of their friends and co-workers. Let's now examine some lean accounting considerations. Some pointers for a lean accounting system are: work towards direct costs. Rather than trying to solve the overhead allocation problem, set an objective to decentralize overhead functions so that they can be directly associated with sales or product lines. Allocate the shared overhead in a way that supports lean. A good way is allocation based on lead time, not on labor hours or activities. Have a general overhead pool for all overhead that is not directly associable with a product or service. As far as possible, record cost by end-to-end value streams. Avoid transfer costs between sections of the value stream. Eliminate variance reporting. Eliminate detailed product cost reporting. Instead, do a periodic estimation exercise together with line managers. Look ahead rather than back. Direct cost associations help considerably. Report product contributions rather than product costs. Use accountants, together with designers and marketers, to look at costing alternative materials and features. Reduce the number of transactions. Reduce reporting time. Be fast and approximate rather than slow and precise. Encourage accountants to think about variation of costs rather than cost variances. Cost variation means looking into the distribution of product costs. Report by exception. Get accountants to think common costs and special costs. Only report special cost events. Reduce the frequency of reporting intervals. Record inventory evaluations in terms of raw material value only. Do not accrue value. Do not show deferred labor and overhead as costs that have been accrued into inventory. Incorporate lead times, defect rates, and customer satisfaction alongside the financials. Note the implications on cash on lean implementations. And if the company has constrained resources, calculate contribution per constrained minute. Know what the opportunity cost of an hour lost or gained at a constraint will be and get the accountants to cost it.